Hello, everybody, and welcome to Hash Rate. My name is Mark Jeffrey. My guest today is Brice of ChickenBonds. But first, a shout out to MEXC. Get up to $4,100 when you sign up using my link in the YouTube show notes. So, hello, Brice. Good morning, good afternoon. How you doing?
Good evening. Yeah, thanks for having me around.
It is evening where you are. Where are you, actually? I don't actually know that.
French countryside, essentially.
Oh, very nice. Okay, so we're going to talk today about ChickenBonds, and I got to be honest, I didn't really know much about it. I first got interested when I saw SIFU posting that he had invested $2 million into ChickenBonds and had become basically the largest shareholder at 17%. And SIFU very famously, I mean, there's a lot of things SIFU didn't do great, but one of the things he did reportedly do very well is he turned $2 million into about $70 million in about 1.5 years during the last bull run. So whatever you want to say about SIFU, the kid knows how to find opportunities for sure. So so before we sort of dive into ChickenBonds, as I was trying to understand it myself, I figured out that I first had to understand LUSD. So let's spend a minute there. Tell me, what is LUSD?
Yeah, because the ChickenBonds are building on one of the components of Liquity, which is the stability pool. Essentially, it's a bit of a meta LUSD, what ChickenBonds output. So yeah, as you were noting, some clues on Liquity is cool to make sure you understand everything. So the very basic level is Liquity is a lending protocol, functionally similar to something like MakerDAO, in the sense that you are not borrowing against a pool. You are borrowing directly against the protocol. You're minting your stable coins that you borrow. You're minting, on Maker, you're minting your own DAI against your ETH or whatever collateral. Same thing on Liquity. You're not borrowing the LUSD supplied by someone else. You are minting your own LUSD that you borrow as you create what we call a trove, which is essentially just a position where you have ETH and you borrowed LUSD. Yeah. So
let me back up to make sure everybody's on the same page here. So LUSD is a stablecoin, and it's designed to be decentralized and unstoppable. So in order to do that, you need some sort of collateral to back it. And so much, as you say, much like DAI, much like MIM, the user comes in and shows up with one form of collateral only, I think, Ethereum. You accept Ethereum, and it's over-collateralized. You put in more Ethereum, so usually 1.5x or 2x. It could be as low as 1.1x, and then you borrow LUSD against that. And of course, if the price of Ethereum drops, it gets liquidated, right? So you lose that potentially, but hopefully you don't. And that is how new LUSD is created. So far, so good. Did I do that right?
Yeah. So far, so good. And so one of the key difference on Liquity is that we have this stability pool. So stability pool is essentially a staking contract where user can deposit LUSD, the stable coin, and they get two sources of yield based off that staking. First one is they just get a fixed LQTY income, so the fee sharing token of Liquity. But the more interesting one, potentially, is that their funds are used to liquidate on the protocol. It's a liquidity backstop of the protocol, those LUSD supplied in that pool, the stability pool. And so what happens is, so those LUSD can be converted to ETH as liquidation occurs. But so, it's usually at a very favorable price because it's a liquidation. So it happens pretty much, when the markets are quite depreciated. And there is a liquidation bonus on top of it, 10%, up to 10%. So it's essentially a buying option on ETH. But yeah, the goal is to just democratize access to liquidations of the protocol. And because the liquidations are essentially already funded thanks to this liquidity backstop, they can happen much faster than on other protocols. And this is what enabled to Liquity to be a bit more permissive in terms of how much you can borrow.
Right. So let me restate that, because actually you answered a question I was going to ask you. So the stability pool is the new thing. That was what I noticed as well. It's like, what is this? I've never heard of this. And my understanding of it, and I think you just confirmed it, is that normally with these things, with DeFi protocols, the liquidations, in order to initiate them, the initiator has to have the amount of money required to perform the liquidation, right? So that's why a lot of these things use flash loans to get the money within the block and then return the money, right? So essentially, the ability to take advantage of liquidations has been a plutocracy. So only the rich could liquidate, basically, right? So, or someone clever enough to use flash loans. What you have done is you've created the stability pool, which is available to anyone to perform liquidations within the Liquity LUSD network. And so you don't have to be rich in order to provide liquidations. And in fact, if you participate in this pool, you get to sort of participate in other people providing the liquidations and collect a little bit of that reward for supplying the liquidity. Yes?
Yeah. So just a small like detail, I guess, which is, there's still people triggering the liquidations. So liquidators, arbitrageurs, call them how you want. The difference is here, they don't need the capital because capital is supplied at the protocol level. But they still trigger something. So, they have bots to monitor for risky troves, and when they get into the zone, when they can be liquidated, they liquidated. And so the person triggering the liquidation get a slight ETH bonus, a share, I think it's 0.5% of the ETH of the trove that is liquidated. And then the stability pool depositors, they buy essentially the depth of the trove together collectively, and they buy the corresponding ETH at, again, most often a favorable price, but ETH can keep dumping after that, and then maybe it's not such a good buy, but still.
Right. So when they liquidate a position, so first of all, you use the word trove. Trove is a loan, like one person's loan. That's what you call a trove. And when it's liquidated, it's the act of liquidation is giving LUSD to the protocol to recover the ETH that is provided at collateral. And the point you're making is usually when that happens in your system, it's effectively like the liquidator is buying the ETH with the LUSD. And just basically because of the way things work, it's like buying it at a 10% discount to whatever, not always, but a lot of the time, like a 10% discount to whatever the
current market
price is at any given moment.
Yeah. And then is that a good deal or not? It's up for you to decide. But, it's still a 10% discount is usually something that rings a bell with people. So that's how stability pool works. And I wanted to explain it a bit in depth because this is the main component ChickenBonds are building upon. So ChickenBonds is essentially...
Yes, we need to understand the stability pool.
Yeah. So I don't know. Do you feel confident to jump into the chickens, or is it too soon?
Yeah, I just want to do one more thing, and then we'll jump into chickens. So, so the success of LUSD at the moment, I looked at on StableCoinsWar, and it looks like there's almost 200 million in LUSD that has been issued, and that's about 0.13% of the entire market share of all stablecoins everywhere. So, it's still small, but it's growing, and it's already double MIM, abracadabra, which I like, but hasn't been doing very well as of late. And this squares with the 423 million TVL in your protocol at the moment, and you guys, the protocol shows that it is 2.3x collateralized. So 186 million is the actual amount of LUSD issued. You multiply that times 2.3, and you get roughly 423 million. So all the numbers make sense. It all works. And you have a couple of curve pools going on, which you also have to understand. The BLUSD, we haven't talked about what that is yet, but we will. Curve pool has almost 5 million in it. And then something I'm calling the 4 pool, you may not, which is LUSD against Tether, USDC, and DAI. That has 64 million in it. So those two pools are sort of important to understand as well. Okay. Yeah. So everybody's got that. So let's go on now to ChickenBonds. Tell me about what is ChickenBonds.
So ChickenBonds is a new concept. Liquity is trying out as a protocol. The idea is to capture protocol-owned liquidity in a sort of game that is harnessing both DeFi and NFT to provide something that is, first, on the user side, offering better yield than comparable solution. So I know, what makes people tick. But on top of that, it's a whole could be described as a sort of a game, essentially, where the people who understand the dynamic properly are able to achieve outsized returns versus some might be able to not achieve such good return. But there is also a very safe way to play the game, thanks to how the bonding mechanism work. So at the end of the day, it's a bit of a, a game of chicken. It's, I would say most people should probably play it pretty safe, just look for a bond rebonding cycle, pretty basic. But what happens is a lot tend to get greedy and try something like buying BLUSD or other strategies that can work, but you need to map them and understand them properly. So yeah, it's how you want to play it, really.
Okay, let me take a step back because I want to understand why this exists. So basically, everything you're doing is to support the liquidity and stability of LUSD. In order to do that, you have to boot up your own protocol-owned liquidity, right? Mm-hmm. So that you got to get the curve pools filled up with, a bunch of coins that could be traded against each other. And the bigger that pool is, the better. You want to get the stability pool that you described for LUSD also very strong and booted up and have a lot of liquidity in it in order to do liquidations at scale as much as you need to do. So those two elements combined, basically you need a bunch of liquidity. ChickenBonds is a way for you to get that liquidity. So that's the goal of that game. Yes?
Yeah, sort of. It's a new concept, essentially, that at first we built really just for liquidity because it's solving one of the situations we have on LUSD. But then we realized it can be bigger. So we're trying it out with LUSD, collecting a lot of data because it's a very unique model. It's harnessing quite a new mechanism, especially the bonding part. So the bonding part is unprecedented that I know of in DeFi. And so, we weren't sure exactly how people would, interact with it. At the end of the day, it's really designed to offer maximum protection to the investor. And so the basic way it works is people bond LUSD to progressively accrue BLUSD, the boosted token. And they have this option as they are accruing to chicken out, which is essentially recovering the full initially invested LUSD amount. And so this option makes it so that, essentially the downside is capped to the yield you would have made with for the LUSD in the meantime.
Yeah, so let me get really specific here because I've actually used it now. So when I go to ChickenBonds, I see a screen where I can deposit LUSD, and I put in 1,800 myself, and my results were pretty interesting. I put in $1,800 on November 29th. I see the BLUSD ticking up, so that's the amount of boosted LUSD where I'm basically accruing things. And I accrued about $500 in BLUSD on the first day, which was kind of insane. That was way faster and way more than I thought. When I last checked it on December 3rd, was yesterday. Okay, so it's faster than the beginning. So it's 1,133 right now. Now, if I chickened out at the moment, so I could chicken out right now. I could just be like, you know what? I'm scared. I just want my $1,800 back, and you give me that option at any time. I can do that. And I take my $1,800 and I go back home, and that's it. But I give up the potential upside. That's basically what I give up. Now, if I stay in, it basically looks like my break-even date is roughly a month in the future from when I initially put in my $1,800. So that's when, chickening out or collecting the bond, they're even basically at that point, is my understanding. Is that correct?
For the break-even, yes.
Yes. Okay, so then then it says that my optimal rebonding period is roughly another month out from that. And that date kind of moves around a little bit, I see, based on kind of what's going on. So what am I trying to make happen here? Am I trying to, what is my ROI potentially in that 2-month period? Or give me a range. What am I hoping for?
So yeah, it really depends of what happens in terms of BLUSD price, and also what price of BLUSD you're able to actually catch when you are rebonding. So to put it simply, lately BLUSD is mostly around 117, 118 market price. But say, that you've got your bond that is, so you were saying getting a break even in a month, an optimal rebound in 2 months, roughly. So say, 45 days from now, so your bond has accrued pretty well already. And the price is still roughly the same, but on that day, someone buys a lot of BLUSD and you have a market price of 125 for a moment. Then, that makes your rebounding assumption instantly much more favorable compared to the basic one when you were building them on 119. So, it's really about this kind of, can you catch this kind of, momentum spike, or not? And that would add a lot to the API. But, on the first month, on the first cycle, because it started in October 4th, so it's been running for 2 months already. First cycle depends of the people, but between above 1% in general at least, but sometimes way more. So my first bond, I think I'm close to 8-9% maybe, but the first cycle was a bit of a special one, I guess.
So 8 or 9% in what time frame? Like almost 2 months?
A bit less. Days? It was 40 days roughly.
Okay, so that's a good outcome. So basically, within 40 days, you make 8 or 9% on your money using the bonds. That is what you're kind of trying to hope happen. And basically because you accrue BLUSD, you do better as the price of BLUSD goes up. You want that price to go up, correct?
Yeah. Okay. And I mean, there are other scenarios too that are favorable to you. So, that are due to what BLUSD is actually. So for instance, if you are holding BLUSD and there is a massive liquidation spike, that might be your best day ever. Because remember that all the yield is essentially stability pool. And so BLUSD is like a leverage stability pool deposit, essentially, to put it simply. So when liquidation happens, BLUSD is getting essentially outsized liquidation returns compared to LUSD.
So basically, if ETH dumps, and if it dumps super hard, that means there's a bunch of liquidations, which means the stability pool is chugging away, making a bunch of money because it's liquidating everybody's ETH. So the price of BLUSD goes up. So it's inversely correlated to ETH. Yeah. Okay. So it's like shorting ETH in a way. Right?
Not exactly, because it's not mechanical. The price can depreciate without too much liquidation. You really need like a sharp, significant drop to have many liquidations now, because most users are careful and following closely and so on.
Yeah. So I also participated. So in order to get my LUSD, I did not buy it. I borrowed it. Nice. So I did it honestly, right? So I participated fully in the system. So what I did, so basically it told me, all right, give me some Ethereum, and you have to give me 110% as a minimum. But, it's pretty easy to get liquidated at 100 and, just 110%, because if it falls below 110%, I get liquidated. So if I put in 111%, it doesn't take much for the ETH to move down to me to get liquidated. So we don't like that. So I put in, so the system suggests you put in at least 150%. So in order for me to get my 1800, I had to put in 2.7K. So that put me at the 150% mark. Blah, 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 blah. Yeah. So my collateralization, so that's pretty safe. So that would mean my liquidation price, Ethereum would have to fall to $883 in order for me to be liquidated. Now, I know that I'm lying slightly because I know that risky troves, even if they're not at exactly the liquidation ratio, making them eligible for liquidation, can still get liquidated just because they're sort of bottom of the pack, right? So that's another dynamic
redemption.
That I found
it's not a liquidation, but it's different terms. Because
right,
it's
we
less
don't need
costly.
to go into that because I feel like that's a detail that doesn't matter here. But I did notice that there seemed to be another way to get liquidated, but whatever. So
no, it's good to be on the safe side, that's for sure.
Yeah, so you definitely you don't want to be floating around 110%. Bottom line, you want to be, and the system as a whole is collateralized at 230%. So it's extremely well collateralized as a whole, which is pretty awesome. And
which is amazing if you're a DGen, because it means you can go 130% and still be pretty safe as long as the whole system is at 200 plus a collateralization ratio. Because of how, essentially a short story, but there is a system-wide mechanism called recovery mode that trigger when that total collateralization ratio goes below 150%. And so this is why I'm saying, as a DGen, you're essentially happy to see others using liquidity responsibly because they give you buffer to be DGen without getting liquidated too quickly.
Got it. Yeah, so you can rely on the stability of the entire system to basically bolster your position. Yeah, that makes total sense. Before we go any further, I want to give one shout out here. So I relied heavily on the writings of a user called Syncubate, and that is their handle on Twitter. So Syncubate actually explained, I read a lot of their stuff. And Cezor's Snack Sandwich DeFi videos. So Cezor was also... Their videos were also incredibly, incredibly helpful to helping me understand that. And I'll have links to both of those things in the show notes. So, okay, super cool. All right, so we've explained now sort of what's going on here. Let's talk now about where exactly... Oh, actually, before we go here, BLUSD. So in order to redeem it, the only place I can redeem BLUSD, and remember, that's my winnings from, when I win in ChickenBonds, I get a big pile of BLUSD. I need to then redeem that back into another stablecoin that I can cash out at my bank, if I want to, or trade it back into ETH. But the only place I can redeem that, I think, is on Curve. And there's a Curve pool with only $5 million worth of liquidity in it. So if I have like $7 million of BLUSD, it's going to be hard for me to redeem it. Do I have that right? Is that correct?
3 million for now of BLUSD overall. So yeah, no, you got it right. Okay, it's just essentially it takes a bit of time, for BLUSD to come into existence because it's accrued over time as you're bonding, and you're waiting for at least break even, but probably a bit after to claim your bond, and so to obtain your BLUSD. And the thing is, the first months of the ChickenBonds, it was a reasonable success, but it wasn't anything crazy. We had like 5 million, 6 million LUSD bonded during that period, maybe 10 million at the end of the first month. And then, the bulk of the deposit, we know close to 55 million, came over mostly the second month. So they're not at essentially the maturity yet. They're not. They will come to this stage in the coming weeks, where they will be able to claim their bond, and then it's up to them to decide if they want to LP or rebond, for instance. But yeah, it's also just a matter of time, and look at the liquidity on BLUSD in terms of the supply of BLUSD, and so right now supply is like 3.2 million. BLUSD, and I think you have at least 2 million BLUSD on Curve in the pool, plus another 200 or 300K on Uniswap. So, with that in mind, it's not too bad.
Yeah, no, of course. I mean, the system needs time to boot up, but I just wanted to characterize the current state of things. And I actually asked SIFU, so I'm surprised he answered me, but I'm glad he did. So I asked him on Twitter, I said, hey, so you're like the big whale inside of ChickenBonds. What do you think? Now it's now it's like a month later. What do you think? Did it meet your expectations? And Sifu says the flywheel performed as I expected. On paper, break even is 6 weeks with no liquidity. Curve pool down to single digit APY, and most bonders have no way to sell the BLUSD at anywhere near market price. So that was so he brought up the BLUSD liquidity as a problem. Now, for a guy like me who's just screwing around with $1,800, BLUSD redemption is probably not a problem. My guess is that Sifu's having a problem because, he's at a much.
Yeah.
He's like almost
Yeah.
20% of the system, so he's dealing in millions.
Exactly. He has like more
you
than
agree?
10 million in bonds in the system. And the thing is, SIFU essentially put himself in a position where, whether he like it or not, his best path forward is to be a liquidity provider if he wants to be a long-term participant into the system. He literally have no choice because, to maximize his yield, he need to essentially grease the flywheel to be able to harness him for himself. And the way he greases the flywheel is providing liquidity. And I mean, we're not neither relying on that to happen because, there are other initiatives being taken to essentially make the liquidity providing position on BUSD a bit more attractive. So a vote is ongoing to get CRV rewards on the pool on top of the current LUSD rewards. And so, yeah, I think this would definitely help attract a bit more people to the pool.
Yeah. Okay. So, and I do want to get into next, where the magical yield comes from. We've hit on it a little bit, but I want to make sure like we really just sort of scoop out every detail here so everybody understands. Actually, before we go there, one other thing that I promised someone on Twitter I would do. I think I know the answer to this, but let me ask you anyway. What is the optimum strategy for using ChickenBonds? I think the answer is baked into the UI, or at least one UI, because I know you don't run your own UI. There are 20, and we'll talk about that in a second. There are like 22 or so different UIs to ChickenBonds and to Liquity. And the one I use, there is a recommended date for rebonding. So I suspect that just do what it says for the optimum output, best guess kind of thing. Is that the answer to what is the best strategy to use ChickenBonds? I guess is the question.
So it depends of what's your goal. But yeah, if the base strategy you want to harness is just to bond and rebond at the best time possible and, keep bonding essentially with bigger and bigger and bigger bonds, then yeah, the optimal rebound time is the time you should be aiming for, the rebonding essentially. But the strategies are wider than that because you need to consider that you can buy BLUSD too, that there is the LP, and all of this can be mixed together. And the theory starts becoming interesting because essentially, to put it simply, if BLUSD market price depreciate, then it means that the strategy where you buy BLUSD is exponentially better than the strategy where you bond LUSD. And exponentially better because, BLUSD is cheaper, so you get more of it for the same price. That's one. All right. But second, BLUSD is cheaper, so the bonders would need more or a longer time to reach their same returns. And third, as you're buying BLUSD, you're getting the yield instantly. You don't have to wait for, 6 weeks to claim your BLUSD and start earning that boosted yield. When you buy it off the market, you essentially, it's like a swap. You get your tokens instantly, and then as soon as you own the token, you are essentially getting the yield because all the yield is redirected directly at the token level through the raising floor price of BLUSD.
Got it. So, yeah. So let's talk about exactly what BLUSD is. And this is I think we have to understand this to understand where the yield comes from. So the thing we're trying to make happen is we're trying to get the price of BLUSD to rise because that sort of lifts all boats of everyone in the system. My understanding is that BLUSD, it represents fractional ownership of the stability pool. Is that correct?
The reserve of the ChickenBonds, yeah, maybe not the stability pool of Liquity. Yeah, it's using stability pool. The whole system is, but it's it's like an abstraction layer on top of.
Got it. So BLUSD is the reserve, which uses the stability pool. Okay, so I was confused. There is another layer on top of that. Well, let's talk about where the yield is coming from, because I think that's sort of relevant here. Mm-hmm. So I did watch a video, and it said, well, it comes from 3 places. First, it comes from the bonders. And by that, and it didn't really explain this in the video, but by that, it means liquidations. So basically, as things are liquidated, yield is produced, and we're getting all the ETH, and we're getting it at a discount. So that's good. I think also the bonders are providing an origination fee. So we should also say when you borrow LUSD, there is no interest. It's zero interest loan, which is very different from kind of everything else. But there is an origination fee, if I remember right, right? So and I think it's like 0.5%. Okay.
Oh,
so that goes. So that is also. Is that also yield? I think it is, right?
So that's not for the stability pool depositors. It goes to the liquidity stakers. This initiation fee when someone borrow on liquidity.
Got it. So if you stake LQTY. Yeah. So go ahead.
So for the ChickenBonds, essentially the main, very by far the most used source of yield is the stability pool of liquidity. And then it's also supplying a bit of liquidity to the Curve LUSD pool. So it's like the secondary source of yield of the system. And the way it works is essentially there is three what are called buckets, kind of internal accounting tool. And they're all here to guarantee a certain function, a certain property of the protocol. So the pending bucket is when users are bonding and they haven't chickened in or chickened out yet. They haven't claimed the bond or cancelled it. Then, at this stage, essentially, they need to be able to recover their assets at any time. So Defense is using a solution that is in the stability pool, but not having a permanent loss, essentially because it's using the B protocol on top of it to sell the ETH and LQTY obtained back to LUSD. And so, if a user chickens out, then, the corresponding amount of LUSD can be unstacked and essentially returned to him pretty much instantly. The reserve is here to back the BLUSD. And so it's funded when users chicken in. The funds are essentially split between reserve and the third bucket, the permanent one. So the reserve backs BLUSD and is accumulating all the yield of the system. So from all buckets, they go to the reserve. So another way to put it is essentially the whole system is redirecting its full yield to BLUSD. And so this is why there is such a large APR sustained on BLUSD so far. And the last bucket, the permanent one, just to wrap it up, it's here to essentially make sure that the system accumulate a form of premium yield amplification that is not purely dependent on users that are currently bonding. So a share of the LUSD when people chicken in are captured to the permanent bucket. And so that secures this like permanent yield premium essentially. And at the same time, because those funds are, essentially, they don't belong to any user, they can be used to supply liquidity on the Curve pool. And if there is a bit of impermanent loss there, that wouldn't be so much of an issue because, again, they don't need to be returned to the users.
Right. So when I chicken in, so I entered the pool with I entered ChickenBonds with LUSD, the stablecoin. When I chicken in, I am effectively at that point giving you all my LUSD, and that is then, and then in return I get a bunch of BLUSD. That's the trade that happens at that moment. And so you take my LUSD and you use it in the ways you just described. It goes in the reserve, the stability pool, and Curve. You basically distribute it wherever the system kind of needs it. I noticed that with Curve, so you have a Yearn vault, which is basically I think using both Curve and Convex, and that Yearn vault is maintaining the liquidity in Curve. Yeah. And it's recompounding, so it's harvesting the Curve and Convex tokens, and for LUSD and whatever the opposite side of the trade is, and making the pool ever bigger. And there is some portion of that which is used as yield and given back to the chicken bond holders in the form of LUSD, or sorry, BLUSD, I think. Is that correct?
So, so essentially, the permanent bucket is using a yearn. It's a yearn vault, as you were saying, that harness convex to go farm the curve pool. And the yearn is redirected indeed to the reserve.
Okay. Okay, so let's talk about how well this is working, or kind of what's going on in the system. So I noticed that, it looks like you've basically got about 60 million moving through the system at this moment. You have roughly 700 users, roughly 1,500 bonds, and when I last looked, roughly 200 had chickened in and 200 had chickened out. Is that does that characterize the system at the moment? Okay. All right. So, well, I think we're sort of getting to the end here of the questions I had. Is there anything I should have asked that I didn't ask? We can go, there are many sides we haven't really touched so much yet. But another really cool side that I like is, the NFT component of ChickenBonds. So, as users go through their interaction with the application, they obtain an NFT that evolve depending of their choice, and even their wallet history and previous interactions on chain. So essentially, when a bond is created, the user obtain an egg that represents its bond, and it's like a generative NFT collection, essentially. So each egg is unique, can have different size, different color, different shape, and so on, depending of the bond parameters and some randomness. And when the users chicken in, they get a mighty chicken that have additional attributes. And when they chicken out, so when they cancel a bond, they get sort of like scared chick running away. It's a really fun component of the chicken bond. And the chicken in NFT part goes really far. It has some things like if you vote for the gauge of the LUSD curve pool, then you will get a bonus attribute on your chicken in NFT. Some really cool mechanisms that weren't really tried before. Yeah, no, that is super cool. I did notice that when I used the website, I noticed I got a little NFT of a little egg, and right now that's it. But the NFT changes based on what I do. So the egg goes away. I no longer have that. I have a new one depending on whether I chickened in or chickened out. And at that moment, I then keep that NFT, and I can maybe sell it, I guess, on OpenSea if I want to, or I can hang on to it as a memento of my time with ChickenBonds.
Exactly.
So, and now one last thing actually I do want to address before I let you go here. So all of the front ends, like all the websites for both Liquity and ChickenBonds, you guys implemented the smart contracts and deployed them, but you left it up to others to implement front ends. And so far to date, there's I think 22 is what I found, different websites that interact with your smart contract. So you can just sort of pick your own front end. Why did you choose to not do your own website, and how did you get other people to do it?
So it's an approach to essentially, again, maximize the resilience of not the protocol per se this time, but the access points, let's call them like that, to the protocol. And essentially the way it's done at Liquity is that instead of building a website, the Liquity team has built a front-end kit. So it's like a little toolkit for developers, for website developers, that they can harness to quickly deploy their own Liquity front-end. It's like doing most of the work for them, essentially. So it makes it easy to create a new Liquity front-end and kind of ease the barrier of entry to that. When we're on the topic of front-ends, they're not just website. Some of them are actually going really far in terms of features and what they're able to do. And so, for instance, DeFi Saver has integrated the ChickenBonds too. Already had the Trove. but they have some interesting tool. Like they have this automatic rebounder that automatically rebound your egg at optimal rebound time, for instance. They have some nice feature with the proxy where you can, in one transaction, claim and rebound or claim and sell. So they really built a neat integration, and they teased us something that got me really excited the other day, which was essentially the ability to use a chicken bond, so an ongoing chicken bond, as a way to protect your debt, your liquidity trove that you have on DeFi Saver. So, an automation that you will set up and essentially, hey, this is my trove with like 50 ETH and 30K debt in there. Hey, this is my bond with 30K LUSD in there. If everything goes right, do nothing. But if, collateralization ratio goes below this price, then you can sell the bond to recover the LUSD and pay back the debt. So I thought this was really cool, those kind of cross-liquidity ChickenBonds interactions. So yeah, worth to shout out.
That is pretty cool. Yeah, so just to be clear, when I want to go over this real quick because I'm actually not sure. So the process of rebonding is I claim my BLUSD and then I sell it for LUSD and then I put it into a new bond. That is how you rebond, correct? Okay. So things like Beefy Finance, auto compounders, this is effectively auto compounding within the ChickenBonds universe. And instead of doing it like 5 times a day, it happens once every 45 days. So the period is obviously much longer, but basically the same idea. Okay, that is super cool. I love that. So, okay, well, we're coming up here on actually, we just passed the 40-minute mark, which is where I kind of like to keep things. So, right. Brice, I just want to thank you once again for spending some time with us and explaining this to me. It's been totally fascinating, and I appreciate you taking the time. So thanks for coming on the show. Of course. Thanks for the invite. It's been a pleasure. Okay. This has been Hash Rate, ChickenBonds edition. My name is Mark Jeffrey. We'll see you next time.